So there's a lot of misinformation out there when it comes to index investing, and in particular, it's really the leverage index investing that's an issue. Um, there's a lot of people out there that say that these leveraged indexes, which what they are really, like, take for example UPRO is the S&P 500 three times. What the fund aims to do is return on a daily basis three times what the market does. So if the S&P 500 is up 1%, it aims to get 3% back. If it's down 1%, you lose 3%. The way that's done is utilizing futures and options contracts and different derivatives, things of that nature, in order to achieve, three times leverage on your money. And so, where the misinformation comes about is about decay and things of that nature. So, the theory is that, because these funds are reset daily, basically they're rebalanced daily, so the shares, everything is sold and then purchased back for the next day. The idea is that, when the market has big drops, that the underlying assets will be resold, purchased back cheaper, and now it takes longer to achieve the growth back, that to get back to where it was before. So if you have like a 50% drop on the index is, let's say, $2,000, that the index is now worth $1,000, what you're left holding is really $1,000 instead of the $2,000. But you need to look historically at the performance of these things. UPRO in the last um, in the last 5 years has returned about 500% on your money. And the reason it does that, even with the decay that people talk about, is because historically, the S&P 500 has a positive daily return of about 0.03% or something along those nature. So it's about a third of, not a third, but it's a third of 10 basis points, which is really like, it's about 0.03 of a percent. So that's why it's done really well. Even given Brexit, it comes back quicker. So even when you have those, that decay and selling, when the market bounces back, you have usually those type of gains. They come right back to you at three times. So you get back to where you were originally pretty quickly. The issue is, with these things, is that what happens if the market crashes, in two scenarios. One is that a 33% drop in one day would, wipe out pretty much everything you own. But we've never seen a 33% drop in one day in US markets. If you take into account a 20% drop, yes, everything will need to be resold, but the 20% that results in a 60% drop will just be in the UPRO ticker for that day, and the next day you start over at the lower price. So the odds of them going to zero are pretty much none, and academics and laymen alike have come to that conclusion that it's not going to go to zero. These leveraged ETFs are not going to zero. They might decline dramatically, but they also, on a rebound, will come up dramatically just as well. So the first issue that people have with it is, what happens if there's a huge plunge and I lose everything? That's not going to happen. The second issue is, what if there is a huge plunge and there is no steady recovery? If you look at Europe, if you look at Japan, you look at places like that, there has been no recovery since 2008. The markets haven't gone back to where they were. And part of that reason is because people lost money are much more conservative in those types of environments, and they just pulled out. A lot of people said, never again am I putting money into the stock market. And in the US, what we did in 2008 was, we were the first really to drop those interest rates so low, to the point that the market was really the only place that you could get a return. So bonds weren't paying out. You couldn't even make inflation on bonds and treasury bonds. So people had to be forced into the market. The theory was that if people are forced in the market and there's all this investment flowing into companies instead of safer, safe haven assets like bonds, gold, things of that nature, that if the interest rate can be manipulated and you force everyone in, that bull run will push back all those people's retirement funds and things of that nature that was lost in 2008. People saw a 50% decline in their net worth. People that have, their retirement and all that saved in their 401k. I mean, those people really took a big hit in 2008. Yes, it came back, and it came back quickly, and that was the point of the really loose monetary policy that we had. But at the end of the day, the ones holding these leverage ETFs, if they just held through the position for a long time, came through. Now, I'm not telling you to buy this in two scenarios. Number one is if, you're putting a big portion of your portfolio into leverage ETFs. That's a really bad idea because, historically the markets may have always recovered, but the history does not tell us what's going to happen in the future. There is a chance, be it a small chance, but there is a chance that the markets could crash and not recover for 10 or 20 years, like 30, 40 years, like in Japan. There's a chance that could happen. There's a good chance that could happen if the right, or dominoes line up with each other. So that's a scenario which you would lose a lot. So my recommendation is never hold a big portion of your portfolio in these things. Yes, they have massive upside return, but you don't want to hold more than 5%, 10% max of your portfolio in them, just because you want the upside, potential, but you don't want the downside risk. And what I recommend is in times like this, that you might want to hedge your position, just because right now we're in the beginning of January of 2017, and the market is, a pullback is long overdue. We've really gotten up here really hot. We got within 30 cents of Dow 20,000. We're now down to like Dow 19,750, somewhere around there as of today. And it could just keep going back. The Trump rally really pushed things further ahead than what they're realistically being, or capable of being valued at. And so and the interest rates, rising at the same time, push the bank stocks up, some of them up 40, 50%, it's too much, too quick. And whenever you have pumps like that, you usually have a big pullback right after. The market takes the stairs up and the elevator down. So you'll have, these things making a ton of money. And, people who held UPRO through that Trump rally made 30% on their money just in a couple of weeks. Of course, right now, that's not the case. Right now, you'd be losing. But over the long term, when you look at these indexes, it works out. But it doesn't work out in every triple leverage ETF or double leverage ETF, because if you're doing something that's really, sector based or directional, like healthcare or tech or any particular sector, you think that's going to make money, you stand to lose a lot more than you do in the S&P 500. The reason it works well with the S&P 500 triple leverage ETF is because it's so well balanced and it's so diversified. So you have really 20% in tech of the S&P 500. You have almost 15% in healthcare. You have financials, another 15%, consumer discretionary and consumer staples, industrials, energy, utility, real estate. It's all in there. So it's very well diversified, and because of that, there's not as much damage when the market takes a hit. But if you see in the pharmaceutical, there's pill and there's cure and there's these other leveraged ETFs that industry, bad news to the industry, like Trump coming out and saying we're going to force them to lower drug prices, that can to a big hit that the sector won't recover from for another year or two, and you'd have to be holding that position for a long time without a likeliness of recovery. So the indexing works for a number of reasons. Pharmaceuticals makes up like 5% of the industries that are represented in the S&P 500. You have tech, like internet, software and services is almost another 5%. There's different types of banks. There's oil and gas stock. There's software companies, biotech companies, semiconductors. These are all sectors, industries rather, that are represented in there. So the way the S&P 500 works is that it's weighted by the market cap. So the bigger the company, the more weight it has in the portfolio, and it's just the 500 biggest stocks really, by market cap. And if you have one of the 500 largest market caps, you're in there, and based on what percentage of that 500 your market cap is, that will sort of dictate the percent of assets in the fund totally that your stock represents. So what you'd see is that in a situation that, where there's shifts in sectors, the market will perform, and the market will still come out on top. It has really, from up days to down days, a 10% bias upwards. So 10% more, on 10% more days, the market is up rather than down, and that's what makes these UPRO and this UDAO really attractive. The UDAO not as much, because the UDAO is only 30 companies. It's not as clear cut. It's not. It doesn't work exactly the way that the S&P works, because when you think about it, the UDAO is more of an actively managed kind of fund, and the Dow Jones, they just pick the 30 companies to put in there, and any one of them could take a hit, could do big damage. When we had that run up to almost 20,000, 70% of that run was from one stock, Goldman Sachs. So if Goldman Sachs wasn't a part of that portfolio of 30 stocks, it wouldn't have ran up as much. Like you see, the S&P didn't run up as much as the Dow did, and that's because it's far more diversified. But what you need to understand about why holding these indexes in the long term works is because of inflation. We have a monetary policy that's based on inflation. Inflation is the target of the Federal Reserve. So they're working for inflation, and you don't want to fight against them and bet on deflation. You want to bet on inflation. And because, the purchasing power of your dollar is guaranteed to go down in 20 years, 30 years from now, even 10 years from now, it won't be worth a fraction of what it's worth now. That translates into the prices of stocks. The prices of stocks, when you think about it, are really just a representation of the prices in the economy. When interest rates go up, bank stocks go up, and that's because it's just all about the cash flow and how much money is going in and out. So if you think the dollar is going to be worth less in the future, then you also have to believe that the stock index will be up in the future, because the 500 biggest companies are just going to grow in terms of the cash flow and in terms of the revenues, because the dollar will just buy less. So, if the dollar keeps becoming worth less, when you go out to buy fruit, they're going to cost more. And because each apple that you buy will cost $1 instead of 50 cents 10 years from now, the company that sells apples will actually have doubled in market cap just by selling the same amount of apples. So it's a win-win situation in the long term, but you have to have that long-term view on it, and you have to be willing to hold through seeing a big swing down 50, 60, 70, 80% on that position. And that's why a lot of people recommend you don't buy these things, because the psychological aspects of holding something leverage like that is crazy. But if you are smart and if you are using it for the right reasons, what it allows you to do is get the same returns you would get on 3 times the capital without putting it in. Another good strategy, which I recommend to a lot of people, is hold the 2 times the SSO, the 2 times S&P 500, and this way, instead of putting all your money inside the S&P 500, you could just hold half your money in cash and put half of it in SSO, and it would be the same result as if you put 100% of your money in the SPY. So you'd have your cash sitting on the side. Yeah, you would have that downside risk, and you would lose just as much as if you had all 100% of your cash in it, but you're still holding on to 50% of your cash. You can make interest on it, you can buy bonds with it, you can do something else with it that's relatively safe, that really reduces the downside risk you have associated with it. So you have to understand, when you're buying leverage ETFs are a tool, and you need to use the right tool for the job. You don't just go jump in blindly because you can make 3 times the return. You have to understand the time frame. You have to know when you're buying in. You have to, in many of cases, average cost price average on these things. I wouldn't go in, at any given particular time. You need to spend a few years building your position in there to make sure that the average price you get is low, and that when the market goes up, you'll be on top, even if there are these slight pullbacks, because you bought and accumulated shares even when the price was low. So if the high was $100 and the low is $50, and you bought at both, you would have $75, and that way, instead of putting all your money in when it's $100 and then the price drops and you're out that much, you have that cushion also. So there's different strategies that you can use or utilize in order to make sure that your investment and the risk associated with those leverage ETFs are not as great. Like I said, the 2 main things you want to do is make sure that you can hold through those down periods. You have to understand that the swings will come back up, generally speaking, and that's just because if really there's underperformance in the S&P 500, those stocks will get pushed out of the S&P 500, and the stocks with the larger market cap, if there's a big shift in sector weight in the economy, if tech really starts taking off, and technology really is our future, if pharmaceuticals and biotech, if we really make big breakthroughs there, and they start taking up a bigger portion of our economy, they'll replace the subsequent sectors that are shrinking in the S&P 500. So the indexing, the way the S&P 500 does, is the smartest way to go about an index. And because of the way it is, it's the S&P 500 is a bet on inflation. It's a bet on the market cap of the 500 largest companies. That's what you need to understand you're buying. You're betting on that the 500 largest companies in the US will increase their market cap. They cumulatively will bring in more money. And as long as you do that and you have that long-term mentality, the risk associated with the leveraged ETFs are not as bad. If you don't know what you're doing, or if you don't have an appetite for that kind of risk, you could always hold the double and hold the other half in cash, or just hold the double over the long period of time. This way you would need to see a dramatic decrease, 50%. The market would have to plunge 25% in a day, and that it's a really rare for something like that to happen. It's certainly never happened in our lifetimes. Of course, if it loses 50% per day, it still won't go to zero. It will always be just cutting back 50% per day. So in the long term, you're really diversified by buying it. And that's the only reason that the only leveraged ETF you should hold long term is the S&P 500. There's no other one that you should hold long term, because you'll never recover from some of the losses. Another thing you can do, which, because people have this argument about, oh, it's the decay. Well, I challenge them. Why don't you short the triple leveraged short S&P 500? When you do that, you're protecting yourself against that decay, and you're just making just as much money as you would going up as if you held the longer position. You could just short that, and they do reverse splits on these things all the time, which makes it a little bit more attractive. But if you're really worried about decay, that's something you can do, is short the short. And this way, you don't have to worry about decay. When the price goes down, you make more. If anything, the decay would help you and make you even more profits than it would holding the long position. So, you know, when you hear all these people, you have to understand it's just opinion. You have to look at the actual facts. And the U Pro has returned, to me at least, about 500% over the last 5 years. It's been one of my best investments aside from Bitcoin. It may even have surpassed Bitcoin, to be honest with you. I think it has in terms of the percentage appreciation that it's done for me. So it's not all-in-one investing, the end all be all of investing, but you could utilize it in a portfolio. It could really help you boost your returns if you're betting long term on the S&P 500. 0.03% or something along those nature. So it's about a third of not a third, but it's a third of 10 basis points, which is really like it's about 0.03%. So that's why it's done really well. Even given Brexit, it comes back quicker. So even when you have those, that decay and selling, when the market bounces back, you have usually those type of gains. They come right back to you at 3 times. So you get back to where you were originally pretty quickly. The issue is with these things is that what happens if the market crashes? So there's a lot of misinformation out there when it comes to index investing, and in particular, it's really the leverage index investing that's an issue. There's a lot of people out there that say that these leveraged indexes, which what they are really, take for example UPRO is the S&P 500 3 times. What the fund aims to do is return on a daily basis 3 times what the market does. So if the S&P 500 is up 1%, it aims to get 3% back. If it's down 1%, you lose 3%. The way that's done is utilizing futures and options come in 2 scenarios. One is that a 33% drop in one day would wipe out pretty much everything you own. But we've never seen a 33% drop in one day in US markets. If you take into account a 20% drop, yes, everything will need to be resold, but the 20% that results in a 60% drop will just be in the U Pro ticker for that day, and the next day you start over at the lower price. So the odds of them going to zero are pretty much none, and academics and laymen alike have come to that conclusion that it's not going to go to zero. These leveraged ETFs are not going to zero. They might decline dramatic contracts and different derivatives, things of that nature, in order to achieve 3 times leverage on your money. And so where the misinformation comes about is about decay and things of that nature. So the theory is that because these funds are reset daily, basically they're rebalanced daily, so the shares, everything is sold and then purchased back for the next day. The idea is that when the market has big drops, that the underlying assets will be resold, purchased back cheaper, and now it takes longer to achieve the growth back, that to get back to where it was before. So if you have like a 50% drop and the index is, let's say, $2,000, that the index is now worth $1,000, what you're left holding is really $1,000 instead of the $2,000. But you need to look historically at the performance of these things. UPRO in the last 5 years has returned about 500% on your money. And the reason it does that, even with the decay that people talk about, is because historically the S&P 500 has a positive daily return of about